You know what's fascinating about market warnings? They're everywhere until the moment they actually matter. Then suddenly, everyone goes quiet. The institutions stop talking, the headlines shift, and by the time the average investor realizes what just happened, the opportunity is already gone. We're in one of those moments right now with gold, and I need to show you exactly what's happening behind the scenes, because the data that's about to drop in the next few days is going to change everything. But here's the thing. Most people won't understand what they're looking at. They'll see numbers on a screen and completely miss the story those numbers are telling. Let me take you back to August 1971 for a second. There was a Sunday night, August 15th to be exact, when President Nixon went on television and made an announcement that would reshape the entire global financial system. He closed the gold window. Just like that, the dollar's link to gold was severed. Now, if you were watching that broadcast, you might have thought, okay, interesting policy change. But there were people who understood what that really meant. They knew that without gold backing, the dollar was just paper. And those people? They started accumulating gold immediately. Here's what happened next. Gold was $35 an ounce when Nixon made that announcement. By January 1980, less than 9 years later, gold hit $850. That's a 2,300% increase. But here's the part that keeps me up at night. The people who made generational wealth from that move weren't the ones who bought gold in 1979, when everyone was talking about it. They were the ones who understood the implications in 1971 and 1972, when gold was still cheap and nobody cared. I'm bringing this up because we're seeing something remarkably similar right now. The warning signs are everywhere, but they're subtle. They're in the data that most people don't know how to read. And in about 72 hours, we're getting a data release that's going to make everything crystal clear. But by then, the smart money will have already positioned themselves. Let me show you what I'm talking about. The COMEX, that's the major exchange where gold futures trade in New York, has been showing some really unusual activity over the past 6 weeks. The registered gold, that's the gold that's actually available for delivery, has dropped by 18% since early October. Now, you might think, okay, so some gold left the warehouse. What's the big deal? But here's what makes this significant. At the same time registered gold is falling, open interest in gold futures is climbing. We're now at the highest level of open interest we've seen since March 2022. Think about what that means for a second. More people are holding contracts that give them the right to demand physical gold delivery, while the amount of physical gold available to deliver is shrinking. It's like a game of musical chairs, except the music is still playing, and nobody realizes there are fewer chairs than there were a month ago. But it gets more interesting. The commercial traders, these are the big banks and institutions that trade gold futures, they've been reducing their short positions. Now, commercial traders are usually short gold. That's their normal position because they're hedging. But over the past 3 weeks, they've covered about 40,000 contracts worth of shorts. That's roughly 4 million ounces of gold they're no longer betting against. When the smart money stops betting against something, you need to pay attention. And here's where it connects to the data that's coming. The Federal Reserve is about to release the latest Treasury International Capital Flows data. This report shows how much foreign money is flowing into and out of U.S. assets. The last report, which covered August, showed something that should have made headlines but barely got mentioned. Foreign central banks reduced their holdings of U.S. Treasury securities by $76 billion in a single month. That's the largest monthly decline since March 2023. Now, when central banks sell treasuries, they need to put that money somewhere. And we're seeing exactly where it's going. The World Gold Council just released their Q3 data, and central banks bought 337 tons of gold in the third quarter alone. That's the third highest quarterly total on record. But here's the kicker. The buying accelerated in September. We saw 100 tons purchased just in that month. And the preliminary data for October? It's showing the same pattern continuing. So you've got central banks dumping treasuries and buying gold at a pace we haven't seen since 2022. You've got the COMEX showing signs of physical tightness. You've got commercial traders covering shorts. And in about 3 days, we're getting the September TIC data that's going to show whether this trend accelerated or not. Based on everything I'm seeing in the gold market, I think we're about to see another massive month of treasury selling, and, by implication, more gold buying. Let me tell you a story that illustrates why this matters. In 2010, there was a guy named John Paulson. You might remember him from The Big Short. He made billions betting against subprime mortgages in 2007. Well, in 2010, Paulson started buying gold. Massive amounts of it. He launched a gold fund and put a huge chunk of his personal wealth into gold and gold mining stocks. At the time, gold was around $1,200 an ounce. People thought he was crazy. The financial crisis was over. The economy was recovering. Why would you buy gold? But Paulson understood something that most people missed. He saw that central banks around the world were printing money at an unprecedented rate. He saw that real interest rates, that's the interest rate minus inflation, were negative. And he knew that in that environment, gold had to go higher. By September 2011, gold hit $1,900. Paulson's gold fund was up over 50% in less than 2 years. Now, I'm not saying we're going to see the exact same move, but I am saying the setup right now is even more compelling than it was in 2010. Back then, it was just the Federal Reserve printing money. Today, we've got central banks around the world doing it. Back then, we had one major geopolitical concern, the European debt crisis. Today, we've got multiple flashpoints, the Middle East, Ukraine, Taiwan, and increasing talk of a multipolar world order where the dollar isn't the automatic reserve currency. And here's something most people don't realize. When countries talk about de-dollarization, they're not just talking about using other currencies for trade. They're talking about what they hold in their reserves. For decades, the default reserve asset was U.S. Treasury bonds, safe, liquid, backed by the full faith and credit of the United States. But what happens when that faith starts to erode? What happens when countries look at $34 trillion in U.S. debt and start to wonder if those bonds are really as safe as they used to be? They buy gold. Because gold doesn't have counterparty risk. It's not someone else's liability. It just is. And that's exactly what we're seeing in the data. Let me give you some specific numbers that really drive this home. China, according to their official reports, has been buying gold every single month for the past year and a half. They've added over 300 tons to their reserves since November 2022. But here's what's interesting. Most analysts believe China is buying way more than they're reporting. There are estimates that suggest China's actual gold reserves could be double or even triple what they officially claim. Why would they underreport? Because if the world knew how much gold China was really accumulating, it would drive the price up and make their continued accumulation more expensive. It's the same reason you don't announce you're buying a stock before you finish building your position. India, another major player, bought 19 tons in the third quarter. Turkey added 39 tons. Poland bought 20 tons. These aren't small countries making symbolic purchases. These are major economies making strategic decisions about what they want to hold in their reserves. And it's not just emerging markets. Even some Western central banks are getting in on the action. The Czech National Bank bought 5 tons in Q3. That might not sound like much, but for a smaller European country to be adding gold right now tells you something about the level of concern about the global financial system. Now, here's where this gets really interesting for individual investors. When central banks buy gold, they're not doing it to make a quick profit. They're doing it because they see long-term structural issues with the current monetary system. They're positioning for a world where gold plays a bigger role in the international financial architecture. And when institutions that manage trillions of dollars start positioning for that world, individual investors need to pay attention. Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical gold into your retirement account without tax penalties, which is something a lot of people don't realize is even possible. Worth checking out if that's relevant to your situation. Anyway, back to what's happening in the market right now. Because the central bank buying is just one piece of the puzzle. We're also seeing something really unusual in the physical gold market. The premiums on physical gold, that's how much more you pay for a physical coin or bar versus the paper price, have been climbing. In some markets, particularly in Asia, premiums are at levels we haven't seen since the chaos of 2020. Why does that matter? Because it tells you there's real demand for physical metal, not just paper contracts. When premiums rise, it means people are willing to pay more to actually hold the gold in their hands, rather than just own a claim to gold on a piece of paper. That's a sign of stress in the physical market. And here's something that should concern anyone who thinks gold is just going to stay range-bound. The cost of production for gold miners has been rising. The all-in sustaining cost, that's the total cost to pull an ounce of gold out of the ground, is now averaging around $1,350 per ounce across the industry. Some higher-cost producers are closer to $1,500. With gold currently trading around $2,650, that gives miners healthy margins. But here's the thing. Those production costs keep rising. Labor costs are up. Energy costs are up. Equipment costs are up. And the easy gold has already been mined. What that means is there's a floor under the gold price. If gold were to drop significantly, miners would start shut alert. Gold stackers got their last warning before new data drops. You know what's interesting? Right now, as I'm recording this, there are people sitting in boardrooms at the Federal Reserve, at the Treasury Department, at major central banks around the world, and they're looking at numbers that you and I won't see for another 48 to 72 hours. And based on what's leaked out through back channels, through positioning data, through the behavior of smart money over the last 2 weeks, those numbers are going to change everything. Let me paint you a picture of what's happening right now in the gold market, because this isn't just another price move. This is the kind of setup that happens maybe once or twice in a generation, and most people miss it completely because they're waiting for confirmation. They're waiting for CNBC to tell them it's safe. They're waiting for their financial advisor to finally admit that maybe, just maybe, holding nothing but stocks and bonds in a world where the dollar is being systematically devalued might not be the smartest play. But here's the thing about these moments. By the time everyone knows, by the time it's safe, by the time it's confirmed, the opportunity is gone. The gold that was $2,600 an ounce is suddenly $3,200, and everyone's scratching their heads wondering how they missed it. Again. So let's talk about what's actually happening beneath the surface, because the story the mainstream financial media is telling you and the story that's playing out in the actual physical gold market are two completely different narratives. Start with the COMEX, the Chicago Mercantile Exchange, where gold futures are traded, where the paper price of gold is essentially set. Over the last 3 weeks, we've seen something remarkable. The amount of gold available for delivery, what they call registered inventory, has dropped by 18%. Now, that might not sound dramatic until you understand what it means. Registered inventory is gold that's actually available to be delivered against futures contracts. It's the real metal backing up all those paper promises. And it's vanishing. At the same time, we're seeing open interest, the number of outstanding futures contracts, climbing to levels we haven't seen since early 2020, right before gold made that run from $1,700 to over $2,000. So you've got more claims on gold, more paper contracts, and less actual physical metal available to deliver. It's like a game of musical chairs, except the music is about to stop, and there are way more players than chairs. Now, why does this matter? Because the COMEX operates on a fractional reserve system. For every ounce of physical gold in the vault, there are typically 20 to 30 paper claims on that same ounce. It works fine as long as everyone's happy trading paper, as long as nobody actually wants to take delivery of the physical metal. But the moment people start standing for delivery, the moment they say, "I don't want your paper promise, I want the actual gold," the whole system gets very uncomfortable very quickly. And that's exactly what's starting to happen. Look at what the big players are doing. JP Morgan, the largest holder of physical gold in COMEX vaults, has been quietly accumulating. Their eligible inventory, gold they own but isn't available for delivery against contracts, has increased by 2.3 million ounces since August. That's $6 billion worth of physical gold they've moved into their vaults in less than 4 months. You think they're doing that because they expect the price to go down? Meanwhile, the Chinese are buying gold like it's going out of style. The People's Bank of China has been adding to their reserves every single month for over a year now. Official numbers say they've added about 300 tons. Unofficial estimates, based on import data and refinery flows, suggest the real number is closer to 1,000 tons. They're not reporting everything they're buying, which tells you something about their intentions. But here's where it gets really interesting. The data that's about to drop, the numbers that have smart money positioning right now, they're related to something most people aren't even paying attention to. Industrial demand. See, everyone focuses on investment demand for gold. Central banks buying, ETF flows, retail investors stacking coins in bars. That's the sexy story. But industrial demand, particularly from the technology sector, has been quietly exploding. Gold is essential for semiconductors, for AI hardware, for advanced electronics. And with the AI boom, with every major tech company racing to build data centers and AI infrastructure, they need gold. Lots of it. The World Gold Council is about to release their quarterly demand report, and the whisper numbers suggest industrial demand is up 23% year over year. That's massive. That's the kind of structural demand shift that changes the entire supply-demand equation for a commodity. And here's the kicker. Gold mining production is essentially flat. We're not finding major new deposits. The easy gold has been mined. The ore grades are declining. It takes 10 to 15 years to bring a new mine online. So you've got surging demand from multiple sources, central banks, investors, industry, and supply that can't respond. This is the setup. Now, let me tell you a story about 2008, because what's happening right now rhymes with that moment in a way that should make every investor pay attention. In the summer of 2008, gold was trading around $900 an ounce. The mainstream narrative was that the economy was fine. Maybe a little soft, but nothing to worry about. The Fed had everything under control. Behind the scenes, smart money knew better. They could see the stress in the credit markets. They could see the derivatives exposure. They could see that the entire financial system was built on a foundation of bad debt and leverage. And they were buying gold. Not because they were gold bugs, not because they loved shiny metal, but because they understood that when the system breaks, when confidence evaporates, gold is the only asset that isn't someone else's liability. It's the ultimate safe haven. When Lehman Brothers collapsed in September 2008, gold initially dropped as everything got sold to raise cash. It fell from $900 to $700 in a matter of weeks. And everyone said, "See, gold doesn't work as a safe haven. It went down too." But then something interesting happened. While stocks continued to crater, while real estate imploded, while corporate bonds became worthless, gold quietly started climbing. By December 2008, it was back over $800. By 2009, it was over $1,000. By 2011, it hit $1,900. The people who bought gold in the summer of 2008, before the crisis hit, they looked smart. The people who bought during the panic, when it dropped to $700, they looked like geniuses. But the people who waited for confirmation, who waited for the all-clear signal, they bought at $1,200, $1,400, $1,600, and they still made money. But they missed the best entry points. Right now, we're in that summer of 2008 moment. The data is deteriorating. The warning signs are flashing. But the mainstream narrative is still, everything's fine. The Fed has inflation under control. The economy is resilient. There's nothing to worry about. Except the bond market is screaming. The yield curve has been inverted for months. Credit spreads are widening. Regional banks are sitting on massive unrealized losses. Commercial real estate is imploding. And the federal government is running trillion-dollar deficits with no end in sight. Quick aside here, because this is relevant. If you're sitting on $100,000 or more in retirement accounts, traditional IRAs, 401ks, and you're watching all this unfold, I put together a free guide on how gold IRAs actually work. It's in the description below. Covers the mechanics of getting physical gold into your retirement account without triggering tax penalties, how the storage works, what the fees actually are. Worth checking out if you're thinking about diversifying some of that paper wealth into hard assets. No pressure, just information. Anyway, back to what's happening in the market right now, because the technical picture is setting up in a way that's pretty remarkable. Gold is currently consolidating just below its all-time highs. It's been trading in a tight range between $2,600 and $2,650 for the last few weeks. And if you look at the chart, if you understand technical analysis, you can see what's forming. It's a bull flag, a continuation pattern that typically resolves to the upside with a move that's roughly equal to the size of the flagpole. The flagpole in this case was the move from $2,300 to $2,650. That's a $350 move. If this pattern plays out the way it typically does, we're looking at a target around $3,000 to $3,050. And that's just the technical target. That doesn't account for any fundamental catalyst, any geopolitical shock, any financial crisis that might accelerate the move. But here's what's really interesting. The options market is pricing in significant upside volatility. Call options, bets that gold will go higher, are seeing unusual volume at strikes of $2,800, $3,000, even $3,200. Someone is positioning for a major move higher, and they're willing to pay up for that exposure. At the same time, the gold mining stocks, the GDX, the GDXJ, they're coiling. They've been underperforming gold itself for months, which is typical late in a consolidation phase. But when gold breaks out, when it makes a decisive move to new highs, the miners tend to leverage that move 2 to 3 times. It's not unusual to see gold up 10% and the miners up 25 or 30%. Now, let's talk about what's happening in the physical market, because this is where the rubber meets the road. Premiums on physical gold, the amount you pay above the spot price to actually get your hands on a coin or a bar, they've been rising. American Gold Eagles, which typically trade at a $50 to $75 premium over spot, are now commanding $100 to $120 premiums. That's a sign of tightness in the physical market. Delivery times are extending. Dealers who normally have inventory on hand are quoting 2 to 3 week delivery times. Refineries are running at capacity. The U.S. Mint has been rationing Gold Eagles to authorized dealers because they can't keep up with demand. This is all happening while the price is consolidating. Imagine what happens when the price breaks out, when FOMO kicks in, when the headline starts screaming about gold hitting new all-time highs. The premium on physical could easily double. The delivery times could stretch to months. And if you're trying to buy then, you're going to pay up significantly, or you're going to wait. Let me tell you about what happened in 1980, because there's a lesson here that's relevant to right now. In January 1980, gold hit $850 an ounce, which adjusted for inflation is about $3,200 in today's dollars. It was the peak of a massive bull market that started in 1971 when Nixon closed the gold window and ended the dollar's convertibility to gold. But here's what most people don't know. In the months leading up to that peak, there was a massive shortage of physical gold. Dealers couldn't get inventory. Premiums exploded. People were paying 20, 30, even 40% over spot just to get their hands on physical metal. And the reason was simple. Everyone wanted in at the same time. The Hunt brothers were trying to corner the silver market, which spilled over into gold. The Soviet Union had invaded Afghanistan. Iran was holding American hostages. Inflation was running at 13%. The dollar was collapsing. And everyone suddenly realized that gold was the only safe haven. The people who bought gold in 1978, when it was $200 an ounce and everyone thought they were crazy, they made 4 times their money. The people who bought in early 1979, when it was $400 and starting to get attention, they doubled their money. The people who bought at the peak, at $850, they lost money for the next 20 years. Timing matters. Right now, we're not at the peak. We're not in the mania phase. We're in the accumulation phase, the phase where smart money is positioning before the crowd arrives. And the data that's about to drop, the numbers that are going to come out over the next 72 hours, they're going to accelerate this process. Because here's what those numbers are likely to show. Inflation isn't dead. It's sticky. It's persistent. And the Fed's ability to control it without crashing the economy is limited. The core PCE, the Fed's preferred inflation measure, is expected to come in hot. Hotter than the Fed wants. Hotter than the market expects. And when that number hits, when the market realizes that the Fed can't cut rates as aggressively as everyone's hoping, when people understand that we're stuck in this high inflation, high interest rate environment for longer than anticipated, that's when gold catches a bid. Because gold thrives in that environment. It thrives when real interest rates, the nominal rate minus inflation, are low or negative. It thrives when confidence in central banks and fiat currencies is eroding. It thrives when people realize that the purchasing power of their dollars, their euros, their yen, is being systematically destroyed. And that's exactly where we are. Look at what's happening in the currency markets. The dollar index has been weakening despite higher interest rates. That's unusual. Typically, higher rates support the dollar, but not this time. Why? Because international investors are losing confidence in U.S. fiscal policy. They're looking at $2 trillion annual deficits, $34 trillion in total debt, and they're asking themselves, how does this end? The answer is inflation. The debt gets inflated away. The dollar loses purchasing power. And gold, which has been money for 5,000 years, maintains its value. The Chinese understand this. The Russians understand this. The Indians understand this. That's why they're buying gold. That's why central banks around the world added over 1,000 tons of gold to their reserves last year, the highest level of buying in over 50 years. They're diversifying away from dollars. They're preparing for a world where the dollar isn't the undisputed reserve currency, and gold is their insurance policy. Now here's where this gets really interesting from a market structure perspective. The LBMA, the London Bullion Market Association, where most of the world's physical gold trading happens, they've been seeing unprecedented demand for allocated gold. Allocated means you own specific bars with specific serial numbers. It's not a paper claim. It's actual physical metal with your name on it. And the waiting list for allocated storage in London vaults is now measured in months. The big institutional players, the sovereign wealth funds, the family offices, they're not messing around with paper gold. They want the physical metal, and they want it in their possession, or in secure vaults under their control. This is a massive shift from the way the gold market has operated for the last 20 years. For 2 decades, everyone was happy trading paper, trading ETFs, trading futures. But now, there's a flight to physical. And when that happens, when the paper market loses credibility, when people start questioning whether there's actually enough physical gold to back all those paper claims, that's when the price can really move. Think about what happened with silver in 2021 during the Reddit squeeze. A bunch of retail investors on Wall Street Bets decided to buy physical silver to expose the paper manipulation. And for a few weeks, you couldn't find silver anywhere. Premiums went through the roof. Dealers were sold out. The U.S. Mint suspended sales.